Hello, everybody, and welcome back to the channel. It's me, Rob Marsiglio, sales representative with Keller Williams Referred Urban Realty. I'm out here in Durham Region helping the great people of this part of the province and doing my best to bring you weekly content on this channel covering all things Greater Toronto Area real estate. Today, we're going to expand from the GTA for just a little bit, talk about a report that came out last week, which claims we may see pandemic peak pricing in 2024. Here's the article in question. It was in the Financial Post on December 14th, and it says, "Get ready for the great adjustment in Canada's housing market. Realtors see home prices regaining pandemic peaks once Canadians accept the new normal in borrowing rates." Shocking headline, the great adjustment. I have so many questions as to what it all means. Let's dive into the article some more. Home prices should climb back to pandemic peaks by this time next year, says a new report that surveyed real estate brokers across the country. Royal LePage predicts that the aggregate price of a home in Canada will rise 5.5% year over year by the end of 2024 to $843,684. Based on this forecast, by the end of next year, home prices will have essentially climbed back to their pandemic peak reached in the first quarter of 2022. But what is this great adjustment? How is this great adjustment going to lead to peak pricing next year? Well, I'm glad you asked, because the article goes on to say buyers discouraged by higher borrowing costs remained on the sideline, and inventories are building across the country. Though sales are down 20 to 30% in some regions, the decline in home prices is modest. Looking ahead, we see 2024 as an important tipping point for the national economy, as the majority of Canadians acknowledge that the ultra-low interest rate era is dead and gone. So surely they do not mean that people will just accept these low rates and that's going to lead to bidding frenzies again and prices going up, right? Acceptance that a mortgage rate of 4 to 5% is now the new normal should untether pent-up demand as first-time buyers flush with savings collected during the extended down market in housing regain the confidence to go home shopping. Okay, so it was that simple in their opinion. Here's a blurb from the report by Royal LePage. You can pause the video here to read it. Again, based on this forecast, by the end of next year, home prices will have essentially climbed back to their pandemic peak reached in the first quarter of 2022. Important to note at the bottom of this graphic that aggregate prices are calculated using a weighted average of the median values of all housing types collected. So we're not talking about CREA numbers or average prices or benchmark prices going back up to pandemic levels. We're talking about this aggregate that Royal LePage puts together going back up to pandemic prices. But in order for that aggregate to get back up to pandemic prices, I'd say we should see CREA's benchmark and average prices for the entire country go back up to early 2022 levels as well. They go a little more granular to wrap up the article, saying that in Toronto, they're projecting a 6% rise in home prices to just shy of $1.2 million. And then my favorite part of the article, we know that there are still buyers on the sidelines waiting for interest rates to come down. What is unclear is how many can afford to jump back into the market at the first sign of a reduction, and how many truly cannot afford to transact in this environment. And that's from Karen Yalewski, the Chief Operating Officer of Royal LePage Real Estate Services. So Karen kind of walks it back from what we see early in this article. Again, they're projecting their aggregate to reach $843,000 by the end of next year. In the article early on, they touch on how the average price of a home at the peak in Canada was $816,000 roughly. So maybe there's some inference on Financial Post report that they're saying, prices are going to skyrocket past peaks. But let's actually look at the CREA data to see what that peak looked like, what this most recent peak in 2023 looked like, where we're at now, kind of what it would take to get back up to peak prices. So here it is. You can see that in February of 2022, prices peaked at $816,720 in Canada. They fell all the way down to January of 2023 when they were about $612,000. They jumped back up to $729,000 in the peak. And just for record, that is the hottest or kind of biggest price gains we've seen in a spring market across Canada in history. From that peak of $729,000 to November's data, it's back down to $646,134. So in order to get from where we're at now back to peak prices, average prices as a whole, not seasonally adjusted, nothing like that, we're talking about a 26% increase in prices through 2024. And as I just said, the jump from $612,000 that we saw last year in January to the peak in May, that was a 19% jump. So even in the hottest market we have seen, we're not talking numbers required to get back up to 2022 levels by next year. When we look at it from a benchmark perspective, benchmark prices across Canada, we peaked at $855,800 in March of 2022. The peak this year was $760,600 in June, and we are currently at $719,000. So we would need to see a 19% increase in the benchmark price to get back up to peak benchmark prices. A big thing in the Royal LePage report is talking about the acceptance of these new rates, and that being the catalyst to people jumping back into the market, outbidding each other, and bringing home prices up. Kind of just discounts affordability altogether. But I think we can look at what rates have done over the past 3 years and compare that to what prices have done, just to kind of show that maybe people already have kind of signaled what a tapped out market looks like, kind of going all in on affordability in Canadian real estate. If we look at Wowa.ca, they do a great job at tracking TD's 5-year fixed and variable rate history. So I want to look at this. The first jump that we saw in benchmark and average prices was driven by the fact that the Bank of Canada had cut rates to near zero, and as a result, the variable rate products were as low as we've ever seen them. This is what really drove prices so high into early 2022. This most recent jump in prices in 2023 has nothing to do with variable rate products because the variable rate was more expensive than the fixed rate. And if you just follow my line of thinking, people are going to opt for the cheaper option more times than not. So a lot more people taking variable products from late 2020 to early 2022. And that all switched over in early 2023 when a fixed rate product was cheaper. You can see there was a big drop off in fixed rate products in kind of March, April. And that's when we saw, right in the heat, right in the heart of that price jump. As soon as those fixed rate products started climbing, people's rate holds started to expire. They couldn't afford prices people were kind of expecting for their homes. That's when we saw prices start to come off again. So we have to bank on rates coming down for people to be able to afford the same prices they're even paying in kind of early 2023, which again, as we talked about, the average price topped out at $729,000 and the benchmark price topped out at $760,000. Nowhere near what we saw at the peak. And yes, there are talks of rate cuts happening in 2024, which would lead to variable rate products potentially coming down. There's also the bond market and bond yields, which are falling off. That's tied to our 5-year fixed rate product in Canada. So there's some pressure maybe downwards on those rates as well. But as you can see, bond yields are not at the levels that they were even at when those fixed rate products bottomed out in March and April of 2023. And the landscape at banks and their outlook is totally different at this point in time than it was early in 2023, late in 2022. And that's reflected in their provision for credit losses. What this is banks saying we have to account for losses based on mortgages we've handed out, credit cards, other types of loans. And you can see that from total in 2022, what they put aside, to the total in 2023 was a much smaller number in 2022. So banks are not expecting things to be maybe so great in 2024. So will they really be giving you big discounts when it comes to the mortgage side of things? Are they going to be willing to hand out money like they were in 2022? I'm not saying it's a guarantee that they won't, but I'm leaning more towards they're going to be a little bit more conservative with their rates. Outside of rates and outside of provision for credit losses, cost of living has also gone up in Canada. You talk about grocery bills, everybody's feeling that in the wallets. We haven't seen food deflation for a long, long time. They got really, really expensive through late 2022 and continued getting more and more expensive in 2023. There's also talks that property taxes are going to be going up right across the board, at least in Ontario. You see reports from places like London, Durham region, York region, all more costs for the consumer. They have to consider these things when they consider the cost of a mortgage as well. And lastly, on the topic, we have big financial institutions like TD coming out and saying they expect 10% declines in prices by the end of the year, early into next year, which again, those will just have to be recouped in order for Royal LePage to hit their kind of pandemic prices. So 10% down means you have to recoup 11% just to get back to where we're at right now. You also have brokerages like RE/MAX saying they think that there's going to be little to no growth next year. They're projecting 0.5% of growth in average prices right across Canada for 2024. But places like the Greater Toronto area could see prices come down 3% in that time. So as a recap, you have one brokerage saying prices could go crazy next year, but then you also have a financial institution saying prices will more than likely come down based on everything they are looking at. And even another real estate brokerage saying, we don't see anywhere near pandemic prices coming up next year. So I'll let you take all of this data and be the judge of what you think. But in my opinion, I don't think we're seeing any growth in 2024. I don't think affordability conditions lend themselves very well to that thesis. We haven't even talked about, the mortgage renewals. So those are all different factors that we need to take into account when it comes to projecting where will prices go in the future. Before I wrap up this week's video, I want to take 1 second to give a big thank you to everybody who has watched me speak on this channel over the last year, people who continue to tune in week after week. When I started this channel, I didn't really have a goal of growing it to a certain number or anything like that. I just wanted to do my best to bring you unbiased content about the real estate market in the Greater Toronto area. We've seen some growth on the channel. It's been great. Kind of halfway through this year, things picked up a little bit. We've seen some growth. It leads me to believe that you are getting some value out of the channel. I hope I can provide more value for you in 2024. I'm really excited to see where things go. But once again, thank you so much for always tuning in and listening to what I have to say and my insights on the real estate market. Until we speak again in the new year, I want to wish you all a happy holidays. Please stay safe and cheers. Hey there, I really appreciate you watching this video all the way to the end. If you enjoyed it, I've got another video for you right here on the screen. And, while you're here, maybe just click on my face, subscribe to. I don't want you to miss anything going forward.